Welcome to Your Business, Your Life with Matt Francesco, your personal financial technician. Whether you've had years of success in your business or are just starting out, Highlift Financial can help you create a vision for your business, life, and family, and align these for generational wealth. So as they say, what happens in your life affects your business. And now, on to the show. Well, hello and welcome to Your Business, Your Life with me, Matt Francesco. And it seems that employee stock ownership plans have been something that's been coming across my radar a lot. I know we recently did a podcast a number of months ago on one. I actually wrote an article for Body Shop Business, and now I've got another expert on employee stock ownership plans, or ESOPs as they are known. And, what I'm trying to do is kind of convey their importance and how they can really work to the benefit of the owners from both a liquidity standpoint and from a tax standpoint. So glad to welcome Stephen Golden. He's a distinguished expert on ESOPs, and he's a key figure with CSG Partners. It's a firm renowned for structuring ESOP transactions. And with extensive leadership in financial advisory, Stephen specializes in guiding businesses through the complexities of ESOPs. As we've talked before, there can be a lot of complexities with that, and especially focusing on tax advantages, Section 1042 rollovers, which we will talk about today, and comprehensive exit planning strategies. So his insights are particularly valuable to the collision repair industry, and especially the shop owners who are seeking liquidity events while ensuring continuity for their employees and also potentially retaining partial involvement in their business. So, Steve, I want to just welcome to you, Your Business, Your Life.
Thanks for having me, Matt. I'm happy to be here.
That's no problem. So again, like I said, I think this is a topic that's been a hot one. A lot of people are hearing about ESOPs, and we want to clear up some of the misconceptions out there and also some of the challenges that are involved with that. So I think really just to kind of start off, as a specialist in structuring these ESOPs at CSG, could you explain what some of the core benefits and tax advantages are to ESOPs, and explain a little bit? We talked about this in the intro about the Section 1042 rollover and how that works for collision shop owners who are seeking an exit strategy.
Yes, sure, Matt. You're in my wheelhouse because I spent 37 years practicing as a CPA in the tax world.
Right.
And in that world, I structured a lot of ESOPs for my clients. And since leaving the CPA world, I've been working on more of the investment banking side and helping CSG on these exact issues that you're raising on the tax side. There's a couple key advantages. And what we always like to say about ESOPs is everybody says, oh, this sounds too good to be true.
Yeah.
There's no way to give these tax advantages. But it's one of the few provisions in the tax law that both Democrats and Republicans can agree upon.
Okay.
They may agree for different reasons, but if anything, they try to enhance the tax advantages to an ESOP, which are already pretty strong, but there
Well,
are things out there where they try and push some more advantages to it.
right.
So let's start with the selling shareholder side, which
Okay.
is the 1042 section that you're talking about.
Okay.
So Section 1042 is a provision of the tax code which allows a shareholder who sells C Corp shares. So I would assume that most of the businesses that you're dealing with are either LLCs or S corporations, but this provision requires you to be a C Corp,
Okay.
and a C Corp has to sell those shares. Now, right away, people say, well, I don't want to be a C Corp. I don't want to be a C Corp. And
Mm,
that's usually, what people think because they like being the pass-through entity, which is the way a closely held business should be structured.
correct.
And so what happens is, for purposes of doing the ESOP transaction, to take advantage of 1042, you have to convert your LLC or break your S election to become a C Corp and sell those C Corp shares. We'll get to down the road when we talk about other tax advantages why that's not such a big deal.
Right.
But assume now that you become a C Corp, you sell your shares to the ESOP. What the IRS allows you to do is take the proceeds you receive and invest those proceeds into what they call qualified replacement property.
Okay.
And you have 12 months from the date you sell to invest in qualified replacement property.
Right. So
So,
I tell you what, Steve, before we go any further,
yeah,
and I know I talked about this in a previous podcast, but I'd like you just to give a very high level view. How does ESOP work? Because when we're talking about selling, it's a little different. It's not like you're selling to a third party. So I'd like you to explain that just again to refresh anybody who may not have heard the previous podcast.
good point. So an ESOP is basically a sale to a trust where your employees are the beneficiaries of that trust. And it's done by hiring a third-party trustee who
Hmm.
represents those employees. But understand that the employees are not involved in the negotiation of the sale between the trustee and the selling shareholders. A group of employees will choose a trustee, but
Hmm.
that's as far as the employees get involved in that transaction.
Right.
And usually what happens is, depending on the business, we would meet with the group of employees. The business owner would choose to be on that committee, and we would suggest questions they would ask of a trustee. We would suggest, 3 to 5 trustees for them to interview based upon the business that's being sold. So it's, that side of it. You're correct. It's not just a straight sale.
Right.
It's a sale of the business owner selling to the trustee who's representing the employees in a
Right. They're selling stock in the company.
stock in the company. And to take advantage of 1042, there has to be a sale of more than 30% of the company stock. It's 30% or more. If it's less than 30%, you cannot take advantage of 1042 as a selling shareholder.
Okay, that makes sense. Again, I wanted to highlight because it's interesting. We're seeing a resurgence in the C Corp now, especially on these internal transfers, because you've got a lot of tax advantages to it. There's ways to fund the buyout, utilizing company resources, pre-tax dollars to be able to do it. I actually did a podcast back like November of last year. It was actually a two-part series with an attorney about C Corps. If anybody want to go back into my archives on the DFRAN Digest on my website at highliftfinancial.com, you'll find DFRAN Digest. Go look up the issues. It's with Stuart Sorkin, who is an attorney. We do many of these for internal transfer. So I would not be afraid of the conversion to the C Corp. So I want to kind of highlight that because I think the C Corp is starting to see a resurgence, especially with the lower tax rates to corporations, which probably is not going to be changing.
That's correct.
So we're buying. So basically, the owner is selling shares to this trust. Okay.
Yep.
He sells the shares. And so then the trust provides money to the owner, correct?
The trust provides money to the owner, but again, the trust has no money. So
Right.
where
Go
does the
ahead.
trust get its money?
I'm gonna let you get it. Okay. So go ahead.
So the trust gets its money in one of two ways. They borrow from a bank, the business borrows from a bank, and then basically assumes the loan. So let's use numbers just because it's easier to talk numbers. Let's say your business is worth $10 million dollars
Hmm.
and you're selling 49% of it because you don't want to sell, let's say you don't want to sell all of it, you want to sell enough and you want to still keep control. So
Right.
let's say there's a sale of 49% to an ESOP for $4.9 million dollars. So the selling shareholder will still retain 51%. The ESOP would own 49%. But where's the $4.9 million dollars coming from?
Right.
So the first thing that happens, and some lawyers do this differently, but there's usually an assumption of the debt. So basically that means that the company assumes the debt of the ESOP to the selling shareholder.
Hmm.
And what happens then is there's based upon the repayment of that debt by the ESOP to the company, there's shares that get released over time. Now, how does the ESOP get its money? The ESOP gets its money through what they call payroll contributions and or dividends, which are deductible payments from the company to the ESOP. So
Okay.
basically, using that $4.9 million number, the first $4.9 million that gets contributed to the ESOP will be deductions for that C Corp.
Okay.
So you talked about low rates in C Corps, which is correct, but even more so, they have built in basically 4.9 million of deductions to be deducted over the coming years to offset that income. like you said, they're basically paying for it with pre-tax dollars because hopefully they're going to wipe out most of their income and pay no taxes at the corporate level,
Right.
which is a beautiful result.
Well,
So,
that's right.
so now you're at the situation where the company owes 4.9 million to the selling shareholder. So it can be done a couple different ways. We do a lot of taking it to banks and getting financing and leveraging up the company and allowing that distribution to that payment to be made to the selling shareholder on his note,
Right.
his or her note. And some people, some selling shareholders will say, I don't want to leverage up my company. Just let them owe me the money, which is their prerogative. They
Right.
could just have a seller note for $4.9 million and get paid interest and wait for the earnings of the company, which they were paying taxes on before, right? Or they were earning money and taking distributions. Now they can take that $4 million out tax free if they do 1042.
Okay. So that's where the 1042 fits in. Okay. That
Yes.
that makes sense. So I know one of the things that we've talked about, and I know I've talked to other ESOP specialists on this, is kind of I guess the kind of benchmark if an ESOP, if a company is a good candidate for an ESOP is to have an adjusted EBIT of around $2 million or more. Again, to justify the costs and complexities of it. Could you elaborate on some of the financial considerations and the typical process for a collision shop owner who's exploring ESOPs as a transaction alternative? Because I've had many owners that have come to me and they've heard the ESOP thing and they do get intrigued by it, but again, it takes some time to really evaluate whether it's the right option. So let's talk a little bit about some of the complexities and again, how can they justify the cost because it is costly to establish them.
Right. So, I mean, there's a few things. One is those, if structured properly, most of those costs would be deductible.
Okay.
So you could either, deduct it, you know, pre-transaction if part of it relates to that, post-transaction to help offset some of this income we're talking about at the C Corp level. So there is some tax advantages to any of those payments. But
Hmm.
I will tell you that there's different levels. So first of all, there's an investment banker such as CSG that would come in and would get paid based, for their work. You would have a lawyer, an ESOP specialist attorney, which would represent the company. Your accountants of the business would probably have a little more work, but honestly, that's part of what I do as a former tax guy is I help our clients, accountants who may not have dealt with ESOPs, I help them understand what needs to be done and what extra work they have. So I help to guide them along the way through
Hmm.
that, which is
Right.
one of the services we always provide. Because it can be,
Oh
you
yeah.
know, if you've never done one before, it's a lot for an accountant to understand.
That's exactly right. It's actually interesting that you say that because, again, I've said there's kind of this resurgence of even the C Corp, and it's amazing to me how many I'll have clients of mine who want to talk to their CPAs about it, and I always warn them. I'm like, look, most of these guys do not understand the advanced tax planning and the complexities of it. It is complex, but it's going to be to your benefit. So you would kind of handhold the CPA who is not that experienced in it to walk him through the process, correct? You're not looking
All
to
the time.
take over the CPA's
Oh
business.
no, I don't want to take over any CPA
There
business.
you
I did
go.
enough of that, Matt. Thank you.
There you go. Okay, good.
But no,
Any CPAs that may be hearing this, let's rest assured we're not looking to take your jobs.
in fact, I will tell you that when I was a CPA, I liked these ESOP transactions as a CPA
Mhm.
because I did not lose a client that might otherwise sell to a roll-up or a private equity or some other. I would lose that client most likely, right?
Right.
But when they did the ESOP, I maintained the client. I got a little more work. So as a CPA, it's a very favorable and interesting transaction. And we have found over the years, as we've brought it to CPAs who haven't seen it because their client brought us to that CPA, they have then said, I like this. I'm going to introduce you to this client, introduce you to
Okay.
that client, because they realize that it's good for everyone. It's good for all the professionals involved, and it's great for the client. It's great
Right.
for the client.
That's great. Well, and like I said earlier, we've talked about kind of this number as this adjusted EBITDA of $2 million, which really probably in the collision world would be more like your multi-shop owners, those type of things. But what if a shop does not have that kind of EBITDA? Maybe they're at 750,000 or a million. Are there any options for them from the ESOP standpoint?
There absolutely are. And we know some, smaller law firms that specialize in it and some smaller trustees who might get involved. You wouldn't have that end of someone helping you finance it. You wouldn't have maybe the different 1042 options available to you or structures that we may have done. But there's certain things that can be done. I don't want to say, you know, more efficiently, but just using less professionals and still make it work the way you want it to work. But in
Right.
a larger transaction, I would not suggest that,
Right.
and that's why we think it's better to have all the parties involved. And like I was saying, so that's just the side of the company and the selling shareholder. But then you have to go out and hire a trustee in any transaction, and that trustee is going to have their own attorney and have their own valuation experts
Mhm.
who help them decide what to pay for the company. And then you have beyond that, you have, if you go out to a lender, you're going to have lenders, and the lenders are going to have counsel. So you have all these parties. And that's why we like to say if the transaction's not above a certain amount of money, it may be like, wow, why am I doing this?
Yeah, exactly. And it's interesting because I think when you look at kind of the demographic of the collision industry, it's pretty much the same as what you'd find in, any small mid-sized business. Bulk of the owners, 60% of them are between 55 and 65, and they're looking at the transition. Now, what's really interesting in the collision industry, and I'm sure this is in other industries too, but it's something that really appealed to me about the collision industry was they're very passionate about the industry, but a lot of owners are getting burned out by all of the complexities, especially with dealing with the insurance companies, with right to appraisal, to short pays, those type of things. And so some of them are reacting and saying, all right, I want out. Okay. I'm seeing the ESOP as a vehicle that allows them to get some liquidity, to be able to take some money off the table, but still be able to maintain a certain amount of control on it. Am I correct in my assumptions there?
100% correct. 100% correct. And we've also seen people, maybe in a community where there's a bunch of different independent shops, and one of the guys is younger and starting out, he could use the ESOP in his company as a vehicle to buy out some of these other shops
Ah.
and possibly structure, transactions where the seller of that other shop could take advantage of 1042 while rolling into the ESOP of the guy who would rather continue with the business.
Oh, that's really interesting because I know there's a lot of younger shop owners who are looking to grow through acquisition. So it sounds to me that the ESOP can be a really great vehicle to be able to do that in the most tax advantaged way.
Yes, we've done that in a lot of different businesses. Yes.
Interesting. So given we talked a little bit about again, they're selling some shares, and I think maybe to equate this in some more common knowledge would be similar to so a shop owner, they want to get some liquidity. They may bring in a private equity firm that buys a certain portion of it. But again, one of the dangers with that is that the owner loses some control because again, the private equity has that. How can the ESOP provide for continuity for the employees and potentially then allow the owners to retain partial involvement in the business and addressing some of these common concerns?
Yeah. ESOP trustees do not want to run a business.
Okay.
They do not want to run a business. They're buying a business based upon its earnings, both prior and forward earnings. They know how the business got there. They know how the business will continue. They're not going to change employees or change who runs the business. They need to deliver for their client, who is the employees in that trust. So if they
Right.
all of a sudden decided, you know what, I don't want the owner to have control, that makes no sense to them. They'll line themselves up for a lawsuit. I mean, the trustee has fiduciary responsibilities to these employees,
Mhm.
and they're not going to want to rock any boats, and they don't want to get involved. They've got, a bunch of these businesses that they're overseeing as a trustee, not, day to day overseeing,
Right.
and they're not going to want to change management. So
I got you.
It's not like the private equity where they're buying in and in 5 years they have to double or triple the people's money who came in.
Right.
This is a trustee who's representing employees, who these employees every year I gotta get a statement saying what their shares are now worth, you
Right.
know? You're basically chipping away at that value, and when they retire, you know, this is what they have. It's a wonderful thing. It's a powerful tool to get employees to be more involved and care about the business.
Yeah, that was going to be my next question about the benefits to the employees. And my first experience with an ESOP, boy, this was probably 15 years ago. And at the time, I was probably longer than that, probably maybe 16, 17 years ago. But anyway, I was early in my business in financial services. I was selling 401k plans and went to this one company who had the 401k and they had an ESOP too. So I started kind of getting some understanding on how the ESOP works. What was interesting was I was working with the CFO of the company and she became a personal client too. And what was interesting was she had her 401k, but then she had this ESOP. And probably by the time they ended up having a final liquidity event, sold the company, and all of the employees were able to cash out. And she walked away with about $2 million. Okay.
Unbelievable, right? Yeah, it's
Yeah, in
amazing.
addition to what she had in her 401k, in addition
Right.
to other assets that she had. I just want you to talk a little bit about some of the benefits to the employees too, because it seems to me this can be a real win-win, not just for the owner, but also for his employees.
Absolutely. So, giving an example of that individual CFO you were talking about, she got $2 million, but that $2 million is in a retirement plan.
Right,
So, there's been no taxation on it until she pulls it out. So,
right,
like any retirement or any IRA, whatever she needs at 65, 70, she starts to pull it out based on the required minimum distribution. And that's all she's paying tax on at the time. So it's an amazing thing. So as opposed to, going out and selling your business, getting $2 billion, giving the government whatever you have to give them based on the taxes, you have sold your business, you've gotten $2 billion, but it's in a deferred retirement account. It's very powerful.
very
And
nice.
that grows tax free, and it's amazing. It's
Right.
amazing. So that individual, and we see it all the time when companies are sold, and you've got employees who never thought they'd have $1 million, and they got $1 million just in their retirement account. It's
Exactly.
amazing.
Exactly. Just maybe a misconception, and again, I want you to address this, is the money that's in the ESOP, okay, is that invested? Is it invested in like securities or is it invested in company stock or a combination of both?
At first, there's really no money in the ESOP. There's
Right.
just shares of the company.
Okay.
So the shares of the company, the value of that grows. And as individuals retire or as individuals leave, the workplace, the company has an obligation to retire those shares, right? And you can either, it gets a little more complicated, but they basically retire. So let's say that you retired from a business and your shares were worth $500,000.
Right.
So most agreements we work with lawyers, that 500,000, so let's say you retire next year, the company doesn't have to fund that $5,000 until years 6 through 10,
Okay.
usually after you retire. Now, there are some provisions where you get it sooner, it gets a little complicated.
Right.
But basically, that $500,000 ends up going into the ESOP trust, and then it rolls out to you in an IRA. So
Okay.
you end up totally away from the company, basically, with an IRA with a value of $500,000. Now, at that time, you could, if you're old enough, you could pull it all out. Again, you could leave it to grow tax free, whatever you choose to do. But
Okay.
the trustee is not really investing funds
Yes. Okay.
for the employees. They're just invested in the business per se.
Okay. So basically, there would have to be a valuation done every year to
Every year.
figure out what the value of those shares are. And it's basically in the growth of those shares.
And remember, even if the company doesn't grow, let's say that the value stays similar, you're paying down the debt. So every time the company
Mm.
puts in a contribution and then you pay back the debt, that releases shares.
Ah,
So even though the share value may not be going up, you're getting more shares that have been released, which are free to the ESOP if there was a.
That's great. I mean, it almost sounds too good to be true. So
That's what I was saying.
I know. So I want to talk about some of the, given your experience, what are some of the misconceptions and challenges that a business owner, especially a shop owner, face when considering the ESOP? And then basically, then the second part of the question is, what advice would you offer to those who are just beginning to explore this type of ownership transition model? So
Yep,
kind of a
yep.
two-part question there. Maybe you want to address the first one.
So, so one of the large misconceptions is that you lose control of the company, which we kind of already discussed, which you
Right.
do not do. Okay, so that is not true. No trustee wants to run your company. Your employees aren't running your company. It's you and whatever employees you choose to help run your company, but
Right.
which is always the case. So
Yes.
that doesn't change at all. That doesn't change at all. The other misconception, it's not a misconception, it's a concern, is that people don't like to put a lot of debt on their company's books. Okay.
Yeah.
But that's exactly what most private equity transactions are. They're just
Yeah.
levering up your company, giving you the same money that we're talking about in an ESOP,
Yeah.
but you're paying taxes on it. And now you have this person hanging over your head who's pushing you to run your business. So that misconception is not true. And we show that to people all the time who have private equity knocking on their door. We say, let's do a side-by-side ESOP, financially. And then also let's look at it from, just, business wise. Who runs your business? How does this work? What happens in 3 years, 5 years? That we try to show that to people that it's those misconceptions. If you're thinking of doing private equity versus ESOP, it doesn't make any sense.
Right. Right.
And
Yeah.
and the other part I hear all the time is, oh, I heard a story about, I know someone who did an ESOP, and a couple years later, the company went under. It was a real disaster. And I say, did the company go under because of the ESOP? They go, oh, no, no, their business got wiped out because of a change in the
Yeah.
law. I said, so that would have happened regardless, right? And they said, yeah. And I said, but did they just get all that money off the table that they
Hmm.
wouldn't have got before? He goes, yes. I go, so I don't think the ESOP was a disaster. I think the company fell out hard times, but they took some chips off the table.
Yeah.
And there's a difference. And that's why, one of the things we talked about earlier was going to a bank and borrowing some money to take some money off the table. We do that always with no personal guarantees.
Oh, that's great.
If you're going to take personal guarantees, you might as well just do a seller note, right?
Right. Exactly.
What's the difference? So we always structure up to a level of personal guarantee. Listen, we've had people say, no, I want to borrow more. I don't care about the personal guarantee. We
Mhm.
advise them that makes no sense,
Yeah.
but we explain it to them. But some people aren't worried about that.
Right.
But to me, to take money out with a personal guarantee, you might as well just do a seller note and pay yourself the interest instead of paying a bank.
Isn't that the truth? And I think, a lot of times, a lot of business owners, because they're kind of self-made, the debt is a bad thing, but we forget about, the different spread. If you're borrowing money at this amount, but you can earn this on it,
Yep,
that's a good investment.
that's
So,
good.
yeah, I think that makes sense.
Absolutely.
So,
Absolutely.
you know what? We're running up on time here, Steve. So, do you
Good.
have any final thoughts? Anything you'd like to share? If people are, this is something that intrigues them about, how they can kind of get a hold of you.
I don't have anything else I want to throw in there, but except the fact that I work for CSG Partners, and you could reach out to me, Steve Golden, if you have any questions. My number is 516-680-8276, or just go on CSG Partners website and you'll see a whole bunch of our smiling faces that
Yeah.
can help you.
That's fine. We're gonna have all that on the show notes, and I would recommend anybody who maybe is looking at these options to contact me, all right, and discuss what you're trying to achieve, what your goals are, and then I can help you to evaluate whether this is an option that we really should look at, and then put you in touch with people like Steve and his partners at CSG. So, and again, you can always do that by going to my website, pilotfinancial.com, and just you'll see a Let's Talk button up at the top, and just click on that. You can schedule. I give everybody 30 minutes of my time, no charge, just to discuss your situation. So, anyway, Steve, I really appreciate having you on here. Would be interested maybe down the road. We can expand on some of these topics in a little greater depth. I know this is very top view on a lot of this stuff. I think that at least my key takeaway is that even given the complexities of the ESOP, that there's a lot of benefits to it, and that you've got people that can hold your hand through the process. So it's nothing really to be intimidated by.
Absolutely right. It can be complicated, but it's worth it.
Yes,
Worth
exactly.
it.
Exactly.
It'll be worthwhile to the shareholder, the owners, and to the employees. It's worth looking
Right.
at.
Right. And I think our jobs, yours as a partner with a investment bank that does these, and me as a financial advisor, financial planner, wealth manager, and exit planner, is taking the complex and making it simple. And I think
Absolutely.
that's really what our goal is too, to, take some of these high level concepts, bring them down, help and make them understandable to you, and then be able to help you to execute the solution that's going to benefit you and your family and your employees for the long term, because that's really, I think, what we're all about, is creating multi-generational wealth for people.
Absolutely right.
So great. So, Steve, again, thank you for being on the podcast. Last thanks always goes out to you, the audience. Thank you for listening to Your Business, Your Life. If you liked what you've heard today, please give us a 5-star review. That way we move up the charts and get more great content like we got from Steve today. If you're watching on YouTube, again, please give us a great review. Love to hear your comments on what you think of the topic or any of the topics that we discuss on the podcast. Again, like I said, the more positive reviews we get, the more we move up the charts to help get this great content to people. So again, thank you all for listening. Steve, thank you for being on. And we want to just tell you to take care and God bless. Bye-bye. Hey, I really want to thank you for listening to the Your Business, Your Life podcast. If you want to be notified when new episodes become available, click the subscribe button below.
All information is obtained from sources deemed reliable but not guaranteed. No tax or legal advice is given nor intended. Content provided herein or on our website should not be construed as an offer for investment advice or for securities, insurance, or other investment products. Investments involve the risk of loss and are not guaranteed. Consult a qualified legal, tax, accounting, or financial professional before implementing any investments or strategy discussed here. High Lift Financial is a DBA for Francesco Financial Concierge, LLC. Investment advisory services are provided through Cornerstone Planning Group, LLC, an independent advisory firm registered with the Securities and Exchange Commission.